Hey, Sam.
Yeah, hey Mathew. I believe you're live now.
Yeah, we're live.
Yeah, good evening, guys. I hope you've been having a very wonderful trading week. Again, a lot has been happening in the market. We've just had the inflation report, Mathew. I think you're following on that also closely.
Yeah, I was following on it. It came up a little bit negative. I was following on it. So Monday, Tuesday was a little bit quiet. Today something came up and excited the market a little bit.
Yeah, definitely.
Yeah.
So today we'll be looking at divergences, and one of the things also that happened is there tends to be a lot of reversals in the market, and divergences is a technique that very many traders utilize to sort of try and identify how to go about trading reversals. Because reversals are things that happen in the market and then they just surprise you. You find that there's a trader who was maybe long a certain position and then you didn't find or you didn't spot that there was a divergence, and then what happens is the market just comes and surprises you or catches you off guard. Yeah. So there are techniques that traders use to sort of identify reversals in prices, and one of them is called divergences. So I'm going to get into what exactly is a divergence. And a divergence simply is when you have an indicator on your chart and the price movement does not coincide or is not in sync with whatever is happening with the indicator. And we'll demonstrate this further when we talk about it. But it's simply that, because indicators at the end of the day are supposed to trail how prices are moving on the chart. And if this doesn't happen, then we realize that we have a divergence. So when your indicator and your price action do not agree, then there's some sort of divergence there that you can be on the lookout for or be prepared in case you are in the wrong side of the market. I don't know, Matthew, if you can chip in on this one.
Maybe just add with what you've said. Remember, you use indicators to try and check out or read the patterns in the market. So just like you've said, Sam, sometimes you need to see that whatever is happening on the price action is actually being supported by what is happening on the indicators. Like if it's an uptrend, then the indicators that you're using should be supporting or should be confirming that yes, you're in an uptrend to give you more confidence. So in this case, we are trying to find out pointers that whichever trend you're seeing in the market, there is something which is not actually in tandem or in line with what the indicators are showing, maybe the volumes or maybe the trend. So that's simply what we try to look in divergences. So a divergence, of course, is an early indication of a trend weakness and likely a reversal. Like I've said, if you're in an uptrend, you want to see that if you've been using a moving average, for example, or maybe you've been using a trend line showing you an uptrend on the charts, then the oscillator which you're using, for example, the relative strength index or moving average convergence divergence, that's a MACD, or even the stochastic oscillator, they should be supporting that uptrend or giving you more confidence that yes, it's a confirmation that you're in an uptrend, so maybe you can keep on with your long position or look for somewhere to enter your long position. But there are some times when you realize that you have a trend that is in progress, but the indicators have started to move in a way that they are not actually supporting or confirming that trend. Yeah, so that's when you realize that there's likely a weakness that is coming up in the market and might be time for you to exit your positions or maybe look for a trade in the opposite direction. If, for instance, you are in an uptrend and you're finding that the trend now is changing, the indicators are showing weakness in that uptrend, then it might be time for you to exit your long positions or look for entries for short positions, or maybe get prepared to look for optimal entries for short positions. And the vice versa is is correct for a downtrend situation. So it can be either in an uptrend or a downtrend. Yeah, Sam? Is it the same case on your side, Sam? Your voice is a little bit low. Hello, Sam.
Am I audible now?
I can hear you now, loud and clear.
Yeah.
So,
So like trading, basically the most optimal entries you'd get as a trader is when there's a turning point at some point. If you're doing an uptrend, then the best places to enter is when there's a short pullback and the pullback is about to turn. So that's also another instance where you can attempt to use divergences, because it's an art, or it's a way to identify potential turning points that can give you the best entries. So you can use it in tandem with other techniques, just to sort of make your strategy a little bit more solid.
yeah, that's for sure. Remember, when you're talking about a trading strategy, there are different approaches someone can use. There are traders who would want to join in a trend which is running. You find a trend, then you join. There are traders who want to get the exact start of a trend, or find a different technique to just enter in the market when you have some confidence that you can maybe ride or get some few pips to the upside, or a lot of pips to the upside or the downside. So this is just an example of an approach that you can use. There are so many other strategies, but this is one of the indications you can check out in the markets to find entries. And of course, remember, you're always looking for a movement, maybe 20 pips to the upside, 30 pips, 100 pips to the upside or downside. And you're looking for a setup that can help you get that movement in the market.
Exactly.
Mm-hmm.
So there are primarily two types of divergences. We've made this a bit straightforward. And the first one is a bullish divergence, and then we have the bearish divergence. So this is assuming you have some sort of oscillator on your charts. Yeah. So a bullish divergence happens when the price is forming lower lows, as indicated here. But then again, when you look at your indicator, be it an oscillator like a or an RSI, the same is not happening. So in this case, you find that price is forming lower lows, but then your indicator is forming lower highs. Yeah. In this case, you find that there is a discrepancy between the price, what is happening on the main chart, and the indicator, and therefore that's a divergence in the charts. Yeah. And then we have a bearish divergence, which is now the opposite of this. When it comes to a bearish divergence, opposite. So you have price forming higher highs, like in this case. But then when you look at the indicator, instead of it following what the price is doing, it's doing the opposite. So it's forming a lower high instead of a higher high. In this case, there's a discrepancy between what is happening on the price and what is happening on the indicator. And therein lies your divergence. So primarily, there are two types of divergences that are the easiest to spot. And as a beginner, these are the best to start with when looking for setups. The bullish divergence, which shows you when price is going to potentially turn to the upside, and the bearish divergence, which shows you when price is potentially going to turn to the downside. I don't know if you can expound on it a little bit more, or
I mean, maybe just add on. This setup is mostly based on identifying the peaks of the market, or the what do you call them? So the troughs or the lows, or the peaks and the lows of the market, because that's what is going to give you the impression that this market is making higher highs, but when you look at the oscillator, it's not making higher highs, just like the price is moving. There's a little bit difference where as the price action makes higher highs, then you realize that the oscillator is making lower highs. That one is like an indication of decreasing momentum. Like in the case here, you're talking about bearish momentum. Here, what we're seeing is a case where the price is pushing higher and higher. Yeah, there's that, it's showing the bullish strength. But when you look at the oscillator, which most of the times will indicate the strength or the momentum in the market, it's showing decreasing momentum. So after some time, then there's likely that the price is going to lose that momentum, or the buying momentum is going to reduce in line with what is happening with the indicator, and it's likely to move to the downside. That's why we're having the bearish, that's why we're calling this one a bearish setup. The same case for the bullish setup. So to add on to what you were saying, Sam, is what the traders need to look out for is the peaks. Yeah, the peaks or the resistance points. All right. And when you look at the peaks of the price action, you also need to check out on the peaks of the oscillator. If you're looking at a downtrend and you want to see maybe exhaustion of the downward move so that you're likely to find an uptrend or a start of an uptrend, then look at the bottoms or the lows of the market, and also consider or compare with the lows of the oscillator which you're using. I think you're going to check out more on those setups once we look at the examples on the chart, Sam. Yeah. Someone here is saying you're here from the group here. We appreciate you here, and we're happy. So just send us your questions and we will answer you. So Sam, you have something to add? You want to take us to the next level? How to identify the divergences?
Yeah, so this is just a step-by-step guide to give you an outline of how. First one is you said actually you've already summarized it. For the bottom, the turning point. Yeah. If the market is forming higher highs, then you mark those tops. Then now you try and identify if you're seeing any discrepancy on an oscillator. So the second thing is the chances are you're going to get really good divergences. So you're going to spot really good divergences when you use oscillators, because oscillators are basically momentum indicators. And the most popular
sure,
are the RSI, and the Mathew. So these ones you can sort of rely on them to give you some reliable divergences in the market. And then now you need to match. I think this is one thing we've been debating a bit, that you need to match need to match the tops of the price actions with the tops of the indicator, the RSI. And if it's the bottoms, then it has to match with the bottoms of the price action. If it's lower lows and if it's the higher highs and lower highs, then it has to match with price with higher highs.
Yeah, I think for matters of simplicity today, and just to keep it straightforward, we will just go with a conventional way of it, just like if it's just the way you've said. If it's an uptrend and you're looking for a divergence, compare the peaks of the charts, on the chart window, and also compare with the peaks of the oscillator on the oscillator window, on the indicator window, sorry, not oscillator window.
When looking at the bottoms or the troughs, then you have to match the troughs of the price and the trough of the. But then if you're more used to it, and if you become slightly more advanced, then you can sort of start to tweak it and I think explore other ideas, because I think trading is how you personalize or customize your system.
Yeah, and as you're talking about trading is how you talking about how someone customizes their tools. I think I'm getting a question here from the audience, and Peter is asking, can one rely on trading patterns to predict the chart trend? And the obvious answer is yes. Yeah.
I think trend essentially is a pattern. If you really think about it, higher highs, higher lows.
Yeah.
Lows,
Uh-huh.
no, it's a downtrend. Essentially, what you're looking at from the word go as a technical analyst is patterns in the market.
Remember, we look at history. We look at the history of the price or how it has been moving to try and speculate. Remember, you're never 100% sure. You're trying to speculate the likely movement of the market based on the previous patterns it has been making. Yeah. So, yeah, you can rely on trading patterns to predict the charts, but you cannot. You need to add fundamentals as well, because it's going to inform on whether that financial instrument is getting weaker or stronger. Like if I remember well, at the beginning, Sam, you started by mentioning the events of the week, which is the CPI, which we had today. And CPI is data which comes up about inflation for the US. And as much as you might have been looking for divergences in a USD pair, then you also need to have details or to be informed on the data which is coming up, the news which are coming up, and then see how is it going to affect the charts. Yeah.
Exactly. I think one good way to put it is patterns tell you how the price is moving, while fundamentals tell you why the price is moving. So then you're able to, you need to know both to sort of navigate.
Yeah. So all of them will complement each other. There are traders who want to choose one and leave the other. Well, if it works for you, remember, you personalize your way of trading, what fits for you. There's no one fit all strategy. So you personalize what works for you. But if you're able to use all of them together, then you are likely to have even better a high probability setup or trading approach in the market.
Exactly. I think from there we can go to the charts. What do you think?
Yeah, we can go to the charts. No worries.
Yeah, so I have a few setups. I think I'll start with mine, and then we can progress from there.
Okay.
Let me share my screen. Just tell me if it's visible.
It's really visible from my end. I see it. So some as you're going to discuss, as you prepare to discuss the divergence, which is very clear as I see there, there's a special request from one of our colleagues, wanted us to show mention a little bit about how someone can log in to the MT4. Maybe you can just mention that, just show us how to log into the MT4. So your voice is low again.
When it comes to signing up, what you basically need to do is to know where exactly to download the MT4 platform. And this one can be gotten from your portal. So you just simply go to portal.fxpesa.com and log in. And then on your, Mathew, do you have, are you able to log into your portal?
Well, I'm going to struggle for now.
Okay.
Yeah.
Yeah. So once you log into your portal, you're going to find the download link under platforms. There's a section on your portal called platforms, and from there you're simply able to choose if you want to do MT4 from the PC or MT4 from the mobile app. Then once you log in, so I'm going to demonstrate with the PC because I'm using the PC. It's going to bring you to this section over here. Just a minute.
On the bottom or the lower right. Okay.
Exactly. It's going to bring you to a section like this, where you simply enter your account ID. So if it's a demo account, you enter your demo account ID, which you can find on the portal. If it's your live account, you enter your live account ID. And then your password, which is what you set from your portal. And then you specify if it's an EGM Securities demo server or a live server. think it's usually live 4. And then from there, you
Yeah.
simply click login and you're good to go.
That's exactly. Thanks for that. It's a request by Jecton, one of our own. And for the portal, someone who wants to log into the portal, just if you're using your phone, if you have, it's good if you have the FX Pesa app. If you log into the FX Pesa app, it becomes even easier, because when you go to your profile pic, where the profile pic is, or where your name is on the FX Pesa app, and you click there, there's a part where a small pop down button. Once you click there, then click on deposit. Even if you're not going to deposit, it just opens you to go to the portal, because in the portal is where you you do all the other activities like depositing, withdrawing, setting up your leverage, setting up your password. So once you do that, once you log in, because you'll be prompted to log in, then you can find somewhere you can download the platforms, the MT5, the MT4, and you will be able now to log in. Once you download, you'll be able to log in the way Samson has explained to us. I think we can prepare a session on how to use the platforms, specifically the FX Pesa platforms and all the platforms we use, to make sure we don't cover a lot of content and deviate a lot from what we are already talking about, the divergences. Yeah,
that's true.
Okay.
Okay, so back to what we're doing. So when trying to identify price action, sometimes it can be a little bit tricky, for especially if you're a newbie. So if you're not so sure about whether you're spotting higher highs and higher lows, or lower highs and lower lows, the simple thing to do is you can start with a line chart that will give you a clearer picture of what the chart is doing. So in this case, if I was to convert this to a line chart, then I'm more able to clearly see where the turning points are, and I'm able to identify my lower lows, lower highs, higher highs, higher lows. So in this case, you find that we have price forming a higher high at this section, and then on the RSI, we have the same spot. Although prices are rising gradually, we have the RSI dropping gradually. So you have it forming lower highs, 2 consecutive lower highs, while the price action on the chart formed consecutive higher highs. So in this case, we see that this is a divergence in prices. In this case, this is a bearish divergence. And what happened afterwards? We had a change in trend, and finally, price melted away and broke structure and now started transitioning to a bearish sort of trend. So that's the first one with Euro, New Zealand dollar.
Very clear. Very clear. Actually, it broke the structure, broke the trend, and a strong downward move came up after that. Very nice setup there.
Exactly. So this was one of the clearer setups, but obviously we might not always have clear setups when it comes to trading. So as we go on, it's good to practice these setups so that you're able to identify even the slightly more complicated ones. So let me switch this. I think I have another setup. This one was the other one was a bearish divergence. This one's a bullish divergence. And it's the same thing. If you're not able to see market structure clearly, just convert it to a line chart. You're able to sort of see where price is turning and what price is doing clearly. And once you're able to mark your levels, you can simply convert it back to a candlestick chart so that you continue with your analysis. And in this case, we had prices generally forming lower lows and lower highs, but we had the RSI in this case forming higher lows. Yeah. So remember, we are matching the bottoms. So in this case, we wouldn't be doing this. Yeah. It's the bottoms. Yeah. So in this case, it's the bottom, and if it's the top, like right here, then it has to match with the peaks. Yeah. So that's one rule when starting out to keep things simple that trader can observe. So in this case, we have a bullish divergence. Price was basically, this showed some exhaustion based on what you're seeing on the RSI. and hence price was unable to break lower, and it just broke this market structure over here, and then it just went up. It just went up from here.
Recover structure, retest, and then continuation. Maybe to make something more clear is when you talk about bullish bullish divergence, it's good to understand that it's a divergence giving you a signal to go bullish, because there might be some confusion when you talk about bullish divergence that it's supposed to be in a bullish market setup. No, a bullish divergence will happen in a bearish market structure, right?
Exactly. Yeah.
So it's just giving you a signal to a bullish move. Same case for a bearish divergence, it's giving you a signal for a bearish move, just like you see in that setup. For which pair is that? I can't see clearly. It's
Euro NSD.
Euro New Zealand. That's nice. Yeah. Classical examples, just like on a textbook.
Yeah, these are textbook examples. I don't know if the next examples are more clearer than that. Like, for example, this one, it's slightly more not a clean example, but still.
I mean, it's clean. It's clean.
Yeah, because you had this one, so it might confuse someone. But yeah, it's a very clean example, especially with this last push. It didn't equate with this last push on the RSI. Yeah.
I mean, it's clean some, because remember we are considering the peaks, and the most significant peak will be important, or will be more convincing, more to say. So looking at that setup, I think it's a very clear one, because you have two peaks there, and the same peaks are being shown on the oscillator. So I think it's okay. Yeah.
So now, when it comes to trading, most of the times we expect divergences to be at the end of a trend. Yeah. So maybe sometimes we can be having divergences on a pullback, because remember, when a market is pulling back from an uptrend, then you'd expect to be entering when the pullback is done and when you want to get back into the initial trend. So in this case, this is one example, slightly more complicated, but still makes sense. We had the market attempting to form lower peaks, but then on the charts, we had a very clear divergence or a discrepancy from what the price was doing. So in this case, this is a clear indication that this move, or this down move, wasn't sustainable, because it was losing momentum, because that's what we are seeing from the relative strength index.
Yeah. And I can also say that, you see, you don't want to use one strategy. You also want to combine with other things that you know in the markets. Like in this one, it comes up as a continuation of the trend. If you check clearly, you see it's a continuation of a trend. It's bouncing along a clear uptrend line, though it's not drawn. Yeah. Another thing is it's sort of a double bottom kind of a setup. So you do not want to rely. You do not want to rely only on one concept. You want to know several others, so that it will help you as a trader to confirm, to give you more confidence, maybe give you confidence to your decision making.
Exactly. I think the best setups are the ones where you have a confluence of ideas coming into play, so you have a higher probability setup.
Yeah, I don't know. Okay, in your case here, I see you've used the RSI. I think at the beginning we mentioned that a trader can use any oscillator, so long as they can point out, so long as it's just showing, it's coinciding with the peaks on the price action. So I have a setup, although I would want you to display it there. There's no reason of us changing, because already on the charts. check out on Nasdaq, UT100. UT100, and this one is going to answer the UT100 on which time frame is this? Let me check out. Go to UT100, and that's on 1 hour, and look out. Okay, use momentum. Use momentum. So UT100 1 hour and use momentum. I won't use that setup as you're working on getting the charts. I want us to use that setup to answer the question that I'm finding here on the audience, that which is the best currency pair to use, or which is the best financial instrument to use for this strategy. And clearly you've seen what you have here on the charts. You had Euro USD, you had gold, which is a commodity. Euro USD is a currency pair, a major currency pair. New Zealand USD is it's a major currency pair as well.
Yeah.
UT100 Nasdaq, it is an index. So I mean, it's more of looking into the movement of the prices and whether the momentum is confirming it or the strength is confirming it. So I think you can use it on any financial instrument. What you have to do is test and see the ones that are likely to give in to such kind of setups. Yeah.
Yes.
So,
yes.
Are you of the same view, Sam?
Yes. For technical analysis, basically, it applies flat out to all instruments. Yeah, because prices at the end of the day are influenced by supply and demand and by market players, and market players tend to show patterns that tend to replicate themselves over time. That means patterns on the chart are always going to be the same flat out when it comes to technical analysis. Then the only difference is now when you get into fundamentals and all that.
Yeah, I see you have the Nasdaq chart, but now give us the momentum oscillator.
Okay.
Give us the momentum oscillator. Momentum, just momentum. Yeah, that one. Just the way it is. Just add.
Okay. Like that.
Good. And now it comes. I know it comes clearly to you. That bearish divergence. Look at the last 3 picks before that downward move.
So it's this one over here.
I know you've seen it already. Yeah.
This one.
You can move it down, lower a little bit.
Over here.
Like that? You can pull it. No, on the left, you can just pull it lower on the left, extend it lower. Exactly, a little bit lower on the left, or you want me to use a more complex term, extrapolate it to the left side. No.
This
that's exactly, it doesn't have to fit exactly at the tips, but you can see. And then now
this over here.
Yeah, it's even better that we have identified that setup as the traders or as the viewers are watching. So is that not a clear example?
Yeah, I think it's a clear example, because at the end of the day, you're looking at the picks and you're looking at what's happening as the picks are evolving. So in this case, ideally, the indicator should be telling you that the second pick or this pick that you've marked should be higher than this pick. But when you look at the momentum indicator, that's not what is happening. So in this case, we have a divergence or a discrepancy between the indicator and the price action.
Yeah, it gave a very good setup to the downside. It's a bearish divergence, which is quite clear.
So I wonder if when you're trading, you're in a bullish trend, this can be an indication for you to exit. Maybe wait for another entry, because it's a bearish divergence.
Well, let me look at it in this way. You're in an uptrend and you've been riding this trend right from if, for example, you're a trend trader. I guess someone had joined this trade earlier enough, right from where you maybe drawn that trend line, and it can be an indication to exit, because at that point you realize that the price is pulling back so fast, right, from that resistance area which is forming there, and then it's forming some sort of divergence or disagreements with the momentum. But then I think for someone to get out of a trade or to use it as an exit, you'd want to wait for the break of that, maybe the break of the market structure or the break of the trend to get a confirmation that the trend is ending, as compared to someone who is looking for an entry to the downside. Yeah, that's how I would consider it in my case. I hope that's what you're looking for, Sam. Sam?
I was actually trying to map out so that it's clearer for the viewers.
Yeah, because I was just saying that for you to use this divergence as a way of exiting the market, I think for a trader who is riding the trend, it's a matter of checking out once the price is not able to bounce on that trend line as it has been happening previously. So
Exactly.
What I said is that the trader might, if for an exit, the assumption is someone was in the market for long or got in early, you've been riding that trend, and now you need to wait and see the break of the structure or maybe the break of the trend, and then check out and see a divergence, and then it proves to you that, well, even the momentum is ending. That's how I would approach that.
Also, one more thing to look at is the size of the candles themselves. Now, this is getting into price action, more of a naked price action. If you see that this up move over here, we had very small candles, meaning it was taking a lot of time for traders or for buyers to push this price up. But then the impulse move down were three very large candles. So this tells you basically that your bullish momentum is basically exhausted at this point. You need to start reconsidering also. So using different ideas together give you a better picture of what is happening in the market.
True. And would want to, at that point, I would want us to answer the question by Diana, who is asking, where would you enter? At what point will you enter on that UT100 example? Yeah, where would you enter? So this brings up the question of, do you consider the price action immediately as the price gets resistance from that trend line, which is giving us divergence? What's your idea on that? And I heard you mentioned something about the candlesticks.
Yeah, I think for me, I'd get back to market structure. Yeah, divergence gives me an idea of, yes, there is a loss in momentum to the upside, yes, but then where exactly should I be looking for confirmation that indeed we are heading lower? So for me, I'd look for a break in structure first, just to confirm for me that indeed we are changing the trend, or we're moving in the opposite direction. Once I observe a break in structure, which is basically a break from the previous turning point, breakout, then that's my go ahead to enter, depending on how these sizes of these candles are going lower.
Yeah, and you must be very conservative. So we have different, that's what makes the difference between us traders. We are seeing the same divergence, but we get different entries. For you, you're giving your example, which is very, very valid, but you are a conservative trader. You actually want to get the confirmation. Okay,
exactly.
Someone,
yeah, I know some traders will.
That's what I wanted to come to. Just go ahead and tell us.
Yeah, for some traders, immediately they see this engulfing body over here of a candle. That's it. It's a wrap. So
that's for aggressive traders, yeah?
Yeah. This is where they enter. Once they've seen that this is peaking like this, and there's confirmation, a little bit of confirmation from the sizes of the candles, and that's it.
Yeah. So it's a matter of choice of what type of approach do you want in the market. You want to be aggressive, then of course there are advantages and disadvantages for that. You want to be a conservative trader, there are advantages and disadvantages for all that. Which is the best approach? All of them are good. It depends with you as a trader, your choice of trading, and are you okay with it? Yeah.
Basically, aggressiveness requires that you are a bit more risk taking. Yeah. So you're willing to be wrong on some setups. you're willing to forfeit some setups just in case you're wrong, because you'll be taking even more entries than someone who's conservative and you're waiting for 2 or 3 confirmations.
Yeah, the risk appetite comes in there, and
But then the pay is also higher, obviously.
if it materializes, because someone gets in, is what they call the sniper entries. Yeah. Yeah. So that's it, Diana. I hope we've answered you. And there's this question from Peter is also asking, can one tell the trend of the market by checking, analyzing one market chart time frame, like 30 minutes or 1 hour? I'm trying to understand your question is whether you can get the trend by just looking at one time frame. Yes, you can, but you need to confirm with other time frames. Maybe, for example, you want to check on higher time frame, it will help you get a clearer picture. What I say is, if you're using a lower time frame, your view is narrow in the market. When you go to a higher time frame, your view gets wider. As you go to a higher time frame, you get a wider view of the market, so you understand what's happening on a larger scope as you come lower to a time frame where you can look for entries. So that's that, Peter. But then we have BOR Junior. How are you? So, Sam, you want to listen what Junior is saying?
Yes.
Has been checking on been checking out on materials on YouTube in chapter 1, then realize it's like it's gone to chapter 7 and then it goes back to chapter 4, trying to learn on your own. So just wanted to ask, what are the basic things that someone has to study to be ready to start trading?
That's a nice question.
Mm-hmm.
So when it comes to trading, you really have to understand, again, I think we mentioned this, how prices are moving and why prices tend to move. Yeah. Once you get a clearer picture on that, then you're able to speculate, because trading at the end of the day is an art of speculation. It's an art and a science of speculation and trying to find the best entries. So when it comes to how prices moves, that's basically your price action, technical analysis. So it's good to learn the basic structures of technical analysis. That is, what is market structure, what are trends, what are what types of candlesticks tell you about the chart, the basics. And then we also have the trend lines and the support and resistance. Those are enough to get you started with the basics, because they give you an entire picture of how the price moves. As to why the price moves, then that's dependent on what asset you're trading. Because you remember, different assets are affected by different fundamentals. For example, in stocks, you'll have different factors affecting stocks. Currencies, you'll have things like inflation and interest rates affecting currencies. Stocks will be mainly profitability, macroeconomic environment, and the likes. Then you'll have commodities, which are basically supply and demand of different global supply chains. For example, copper, when the economy is booming, then expect there's a higher demand of copper so that industries are able to produce more, and the likes. So first, get the basics of how prices move, your technical analysis, price action, and then get the basics, the very basics. You don't need to focus. You don't need to start on all assets at once. You can start with currencies, for example. Just learn inflation and interest rates. That is enough to get you on why prices move, because a lot of things that happen in currency markets primarily center around those two when it comes to fundamentals.
Mm-hmm. So like what you're saying is you can't go to grade 2 before you start from grade 1. Yeah.
Exactly.
You
So
can't
then
get to grade 4 before you pass through grade 3. And it's always good to appreciate that journey. You go to first year, then you go to second year, and then third year.
Exactly. So once you've had the basics, then you're able now to tweak around, do a bit more niche topics like divergences, do a bit more in terms of going deeper even in fundamental analysis once you have the basics, because basics are your base for understanding other things.
become the stepping stone to move to the next level.
Exactly. Also, we offer these in our classes and training sessions.
Only that we're working from home right now, and you can see me. I'm just in my my FX Pesa jumper. Next time when we're doing these sessions, I'll be on a tie because I'll be in the office. But yeah, we do it in our offices actually one-on-one. But once we're able to resume, then of course we had also gone to exercise our democratic right. Yeah. So yeah, once we get back, you can come and we look at all these setups and look at them one-on-one. Any questions you have, we will be able to answer them. But even most importantly, maybe to give more direction to BOR, check out on our stream of videos. We've got very basic trainings and recordings like these ones, and like support and resistance, candlesticks to look out for. Start from the basics. If you realize that something is heavy for you, just leave it, go back to the basics, learn a little bit, appreciate the process. This is a journey that you take, and over time you'll be able to understand even deeper concepts on trading. So
yeah, just I forgot to mention, we have an A to Z on Saturdays.
Yeah,
on all our centers. So I think that's one way to get through the basics fairly quickly.
Oh yeah, because for the A to Z's we cover the very basics that we've not been able to look into during the week. But again, once we're able to resume our one-on-one classes, the physical classes, that's when we'll be able to do that. And of course, we will let you know. All right, Sam, anything you have to add?
I think that wraps it up.
Our dear listeners. Okay.
Inflation has been really interesting, so we react accordingly for the rest of the week.
Yeah. So by the way, what's coming up tomorrow? Maybe we can mention before we go what's coming up tomorrow. Today was CPI inflation. Tomorrow we still have a related inflation data. It's producer price index, PPI. Yeah.
Okay.
And unemployment claims coming out tomorrow.
That's nice. Yeah. So that one now is on inflation from the producer's perspective instead of the consumer's perspective, because we need to know if they're transferring that inflation or they are absorbing some of those costs themselves. Yeah.
And on Friday we will have a GDP for Great Britain. So for the guys who trade on a pound, look out for that as well. Only that you mentioned about the fundamentals of just said, we mentioned a few of what might have coming. So then up to that point, thank you so much to our viewers and listeners. Let's keep engaging on social media. You can follow us, follow FX Pesa on of course you're here on YouTube. Check us our page on Facebook, on Instagram, on Twitter, and Sam, you also host Twitter Spaces, right? Yeah, we have
Spaces Rufus, on Sunday
Rufus.
now. Rufus, on Sundays.
Yeah, with a lot of experience. Yeah, you just go and listen, and of course you have a lot. Even for us, we learn from each other. So also take some time and listen to those conversations. Get to build yourself and learn more and more. For me, I'm also on Twitter. You can check out my handle on at Mathew_Kabere. Okay, let's keep interacting as well. Sam, your handle?
My handles are usually the same. Samson Mzera on all platforms. So you can also follow for content that I tend to share there.
Okay, and up to that point, then I think we just gonna call it a session. Thank you so much for your time. All the best. Let's keep the peace and keep trading. Bye for now.